Alrighty then. So today we're just going to focus on mutual funds. Mutual funds are probably the product that you'll be most involved with. You know, I've spent a fair amount of time talking about stocks, and I'll continue to. But to buy individual stocks, unless you're into it in terms of a hobby and all that kind of stuff, probably not realistic. Most of the time, when you're working for a company and they're funding your 401k and you're contributing, you're not typically allowed to invest directly in stocks. You know, you have to pick one of their mutual funds, which is just fine. It kind of keeps you out of trouble, and it gives you some diversification. We'll talk about that. I worked for one company where it was kind of funny. They had a program where up to 50% of your account could be in self-directed funds, meaning I could trade stocks with 50% of that money, and then every year they'd do an annualized thing, and they'd see. Well, I'd get a note from them saying, "Hey, you need to reduce the money in your self-directed account because you're way over 50%." Well, that's due to the fact that these guys, they wouldn't let me put you know, the mutual funds that they had, and mutual funds in general just were not that attractive. And not that I'm that good, but the market was super strong. There's a lot of people who in the past 10 years didn't have to be all that bright, but could kill the market because it was a bull market that was going up. And so there maybe will be a bit of a shaking out here now that things are going a little bit differently, and you know, some people who think they really have talent will figure out that maybe they just really had a lot of luck. But anyway, if you do have that opportunity to go self-directed under one of those type of accounts, do it. I mean, it worked out great for me, and it was a lot more fun. But the pukey funds they wanted me to be involved in were they got mediocre performance, and so anyhow. So mutual funds. The good thing about mutual funds is they're very easy to trade, very user friendly. You know, the deal with a mutual fund is that there's supposed to be a manager if it's a managed fund. We'll talk about index funds where they just sort of buy and hold across an index. But theoretically, when you have a managed fund, they can make buy and sell decisions. So right now, you know, people are talking about, oh, you know, the economy's, the market's at an all-time high. Is it time to set stuff aside? Is it time to, you know, change up strategies? Those are decisions that fund manager should be thinking about right now, not necessarily you. So it sort of takes the burden away from you. And if they're worth their salt, maybe they'll make the right decisions. If they're not, then maybe you need to, you know, find a different fund in the next few years. So anyway, the reason why I have the stock market, you know, this is just the Dow. This is just the all the stocks listed on the Dow Jones, and you can just see that basically verticality of this chart. I mean, you're not getting this with gold. You're not getting this with cash. It would be going the other direction as inflation erodes it. So, you know, like I say, you gotta kind of get off the porch. I mean, there's some dips now and then, you know, the Great Depression, the Great Recession, I guess they call it. But, you know, the people who got clobbered in this thing are people who said, oh, God, it's going very poorly, and then they got out right down here, and they got clobbered. People who said, oh, this is going to kind of suck, but I don't need this money for a little while. I'll just weather this out. And, you know, even though they took massive hits that was in whatever, happened in 7 and 8, and by, you know, certainly by 2010 they were made whole again, and they're on the way back up. So, you know, the worst thing to do is panic and get out of the bottom. So if you don't have the risk appetite for it, and you're going to do something, you know, sorry to say, foolish, and jump out at the bottom, maybe you shouldn't be doing it. But if you you know, this is why you don't put money in it that you're going to need next week in the stock market. And this is also the argument, you know, for a lot of people that are getting into the retirement years, they could be passing away here before the market recovers. So that's not a good plan. Or they're, you know, relying on it for income. So lots of reasons to get more conservative, but there's lots of reasons to be more aggressive when you're young. So anyhow, mutual funds. So stock mutual funds, you'll hear the term stocks, you'll hear the term equities. It means an ownership position, right? Stock means owning a position in a company. Mutual funds can have bonds in them. Bonds are just the loans to the companies. Stocks far more popular though. All managed by professional portfolio managers who yeah. But a lot of times, and especially again getting back to this bull market that we've been through, just with the buying and selling and the churning and the doing everything they do, sometimes they generate more expenses than they're creating a lot of activity. The whatever the term is called, churn, where they're just doing a bunch of stuff. They look busy. They always want to buy and sell, and at the end of the day, they're maybe not quite getting it right. Market timing is exceptionally difficult. Trying to, pick the top and the bottom. A lot of people far smarter than I have tried to do it, and they just haven't been able to pull it off. There's other ways to get ahead, so kind of a buy and sell. So anyway, we'll talk more about index funds, but index funds are a way of kind of taking the professional portfolio manager out of it. There's no buying and selling. They choose the Standard & Poor 500, and they pick a certain number of shares per each company listed on the Standard & Poor, and they buy those shares, and they sit on them. There's more people buying in the fund, then they buy more shares in all those companies, but an equal amount. They don't do any hedging or jumping in, jumping out, market timing. Nope, they just buy and hold. Therefore, it doesn't really take much of a professional. A trained monkey could do that. Once the trades are made, the initial trades, they just sit there and watch. And so the expenses are very low. They're not generating a bunch of extra charges. So the money you make is the money you keep, rather than have expense ratios at the end of the year. So the homework assignment, we're back into a little bit of homework, but it's kind of interesting. We'll be focused on that, and it goes back to a podcast. You've heard me reference Warren Buffett, the Oracle of Omaha. Smart guy. He's whatever. He does some real good things. But he's not Mr. Benevolent. He's claims to be an environmentalist because he's against pipelines going across places. Well, guess what? He owns all the trains, so all that oil has to go in the trains. He's definitely, he'll do things to benefit himself. But he is a big, very successful. Berkshire Hathaway is his fund. Incredibly successful. And obviously I can't talk down to Warren Buffett. I mean, nobody's quite in his league, but anyway, some of his political stuff is kind of sketchy. Motives for investing in mutual funds. So small investment, yeah. There may be, you may look at the thing and start an account with a minimum deposit of $1,000 or something, and then you read the fine print and it says, but with regular deposits from your paycheck, some sort of direct deposit, you can start it for $50 or something. I mean, it can be. There's really no lower limit. The expertise of the portfolio manager, talked about that. They're going to have a nice prospectus. A prospectus is a thing that it's kind of like the rules of the road. So you know what you're getting in on. You have to at least acknowledge, the rules. And it's not like an end user license agreement on the computer where you just skip through it. Now this one, it's written in clear language. And it says what they can do, and if it's stuff like if they say, oh, they can buy these certain stocks or certain sectors or trade internationally or use shorting or things like that, then they can do that. If it says they can't do that, then so it can tie their hands. If you don't want them doing getting too fancy or for me, I usually wanted to be more aggressive. So anyway, whatever fits in with your investment criteria, but the kind of the rules of the road, their guidelines are put forward in that prospectus. Net asset value, since they're a collection of stocks or bonds or whatever, they don't have like a single stock price. And this used to be a bigger deal, but now, whatever. Again, with computing power, 300 stocks held under one mutual fund instantaneously for the price. It's not that big a feat for a computer. You can get quotes within the day, and they have their own share thing. You can also use this for quotes when you're looking on a chart. You don't have to use goofy data. It used to be where mutual funds only released their NAV at the end of each day. And now that's all changed. And then there's even hybrids in between stocks and mutual funds, exchange traded funds, which again make it a little bit more of a hybrid in that area. Open end versus close end. I'm not going to spend a lot of time on this. The big thing you need to look out for is loaded funds. Load in mutual fund speak means a commission. If some fancy whatever comes and makes a presentation to you, and he's got your best interest at heart and buys you dinner, and he's probably selling you a loaded fund, and don't do it. There's plenty of no load funds out there. The better funds are no load funds. Now, that being said, if a fund has a high expense ratio, I wouldn't necessarily rate funds strictly on their expense ratio. If the fund manager gets a fair amount of money for doing what he does, if he's getting the results, then he's essentially like a football team coach. You pay big money to the successful coaches, and to the ones that aren't good, then they don't get paid much. So if you're looking for the lowest paid coach, you may end up with the lowest results. So it's not always indicative, but you got to look at everything. But a front-loaded commission is not something you normally want. Sometimes there's back-end commissions where when you sell the fund, there's a commission paid. If I had to pay a commission, I'd rather do that because now they got some skin in the game. If they turn my $1 million into $10, they're screwing themselves. If they turn my $1 million into $20 million, they're doing quite well. So they've got a vested interest in making me money. On a loaded fund, they get your money up front. See you later. They're on to the next dude. So anyway. But anyway, open-ended. Sometimes also with mutual funds, they do not typically want you jumping in and out. In fact, they really will try to discourage it. In some funds, they'll have rules where you can only, trade in and out at certain times because the fund manager, he wants sort of a stability in funds so that he can protect, and know what he's working with. The other thing about funds is sometimes they will close funds to prevent them from getting too large. Let's say you're got some mega fund that's doing, investing in startups. Well, that's just not going to work. That mega fund, once they even talk about investing in a startup, that's going to artificially inflate the price of that company. And when they get out, it's going to, they're the elephant in the room. There's a series of funds, Cathie Wood's, ARK, who, they try and get in these small ventures, but man, that it's hard to tell what the underlying strength of the companies they're invested in is because the price of those companies is sometimes distorted by just the fact that ARK has shown an interest and ARK has dumped money into them. So there's reasons why they may want to keep them smaller, close them, and do things like that. And then there's other things where, but this whole closed end, it's like anything else. There's millions of different definitions and ways. Closed end, if I said that to 2 people or 3 people, I might get different things. I'll just tell you about closed funds. These other ones with commissions and loaded funds, you don't want to be involved. So load versus no load. No load, sell directly to investors. Load, sold by stockbroker, whatever. The term load, just think commission. No commission, commission. And they do have a significant income or impact. The problem is that they take their money up front. So you invest 1,000 and they take, 100. Well, now you're investing 900. Well, the effect of that missing $100 over the life of your investment is huge. So anyway, here's a comparison. Turns from a no load to a load fund. So, yep, 5,000, commission of $200. So only 4,800 is invested down here. So they only bought 240, and up here they bought 250 shares, same price. But at the end of the day, what's the return? Whoops, we got 10% up here. We got half that basically below because part of the money was just gone. Expense ratio. This is what I'm talking about. Average expense ratios, whatever, management fees, 12B. There's little fees that add up, administrative fees, legal fees, but they're all published. If a fund's getting, 20% a year, hey, I can put up with some expense. If a fund's doing mediocre performance and they're still taking big chunks, then I'm shopping around. And you can move from fund to fund, over a course of years. You don't day trade mutual funds, but certainly, when it comes time, when you are, say, immersed in your career, busy with everything, and you glance at your portfolio every 3 months or so, if it's not doing what you want, you need to make some changes. Lower expense ratios. Yeah, when everything's going well, if all boats are rising, if it's a bull economy. But if somebody's got a high expense ratio, I'm just saying there's more to it than just expense ratio. All things being equal, if everybody's going up and one has a high expense ratio than the other, yeah, it's going to affect your performance. But if somebody's getting me remarkable returns, I don't mind paying them for it. So growth funds. Small companies typically, or companies that are growing. Go figure. So these terms it's almost like some of these banking terms where it's more marketing than anything else. The difference between capital appreciation and growth. Well, a growth fund, let's look at the definition of capital appreciation fund. Mutual funds that focus that are expected to grow at a very high rate. Well, yeah, those are kind of the same thing. So there's not going to be a definition. There may be a broad definition between a growth fund in the fact that they get the profits in a growth or capital appreciation fund, and they're generally trying to grow the business, and so they're putting whatever profits they get into growth, buildings, equipment, research, as opposed to an income fund, which we haven't talked about on this page. An income fund, they're more established and they're getting their profits and they're returning them to the shareholders by way of a dividend. So, like I say, I generally don't find myself in dividend stocks, income stocks, which, whatever, as I get older, that's not the norm. For you, as a typical, early in your career, early in life type thing, probably ought to be in growth rather than income funds. But again, personal preference. So small cap, mid cap, equity income funds. So small cap, this just refers to the size of the company, and there are limits, so many billions and a few more billions, but not quite a large cap, And then here's an equity income fund. Now, when you see that word income, that income equates to dividends. So not necessarily in the growth phase. If it was a growth phase, they wouldn't be paying dividends. They'd be dumping it into stuff. So they go small, mid, and then equity income. So it could be kind of small, mid, large cap, General Motors or whoever, GE, somebody like that. The kind of old, boring companies. Stock price isn't doing that, it's not doubling or any of that kind of stuff. So they, in order to keep investors, they pay a dividend. Balanced growth. So again, growth, and you can get any mix you want. There are more mutual funds out there than there are underlying companies. Now this is kind of interesting too, and these can be growth or whatever. This is just a whole different category. You can have sector funds. But sectors can be split up however you want. Sector can be medical, defense, something. Or they can also be geographic sectors. Pacific Rim, Europe. God forbid why Europe's not known for a robust stock market. But anyway, you can pick different sectors that you think are going to do well. Anyway, technology funds. Yep. So if you're, and what you do, this is only the broad research. You come up with a particular fund, which we'll kind of look at a little further, and then you look at their underlying assets. And any mutual fund, you can look and see what their top 10 holdings are. And they should be probably pretty familiar names, unless they're really small startup companies. Index fund. So this is kind of the no-brainer one. When the market's doing well, and you don't want to pay a bunch of money for fees, you just buy an index fund, which just buys, a portion of the entire index and just buys and holds, and just trundles along. But because of their low expense ratio, they've outperformed a lot of these highly traded ones. These guys with all their effort, but also all their salaries, in the end, they haven't typically got the returns that some of the index funds have. International stock fund, not to be confused with the global stock fund. International means everywhere but the U.S. Global means everywhere. Socially responsible. I'm not a big fan of these. Some people can may want to jump in, but sometimes some of the, you got to see how they define their responsible funds versus, for example, I might consider it, and I think a reasonable person might go, wait, nuclear is socially responsible because it has less impact on, other things. Some people might say, oh, no, it can't include nuclear. It can only be, geothermal and wind and solar and whatever. It gets very political if you want to go that route. Explore what the underlying assets are and see truly that your ideas of social responsibility equate to their ideas. I'm not saying it's bad at all. I mean, there are some bad companies out there that do bad things that should be punished. And, this might be a way of you to screen through them. But anyway, sometimes you've heard the term greenwashing, I believe, where it's just, oh yeah, we're environmentally, Subaru puts a thing on the back of their car saying they put out 0 emissions. Really? 0? 0 is a very small number. In fact, there's a little something coming out. But anyway, not that I'm bashing Subarus, but it's just pet peeve. Okay, other stock funds, further divisions. Yep, they can be divided however you want. There's literally 10, 11, 12, 15,000 of these mutual funds. Not all of them are doing well, but they can be whatever. They'll sound like they're tailor-made to exactly what you want. So don't be overwhelmed, and I'll show you kind of how to do that, because there are third-party people who don't care. They don't have a dog in the fight. Their reputation is based upon providing you information, and typically for a price. Fair enough, but that's how you get fiduciary information, and you can maybe make better decisions rather than reading the propaganda that you see. So ETFs, exchange traded funds. This is because mutual funds had gotten so big that the stock market people were kind of feeling like they're being left out. They wanted to get in there and offer their customers kind of a better product, because it can be traded throughout the day, and they're meant to be traded, So again, it puts the brokers and the markets back in the action, rather than just have these institutional investors have all the money and then them come to the stock market. The stock markets this way can make other programs. So anyway, ETFs kind of come and go. The Bitcoin ETF right now is booming, the most successful ETF launch ever. And it does provide a mechanism for people to get 401 money into crypto, whether that's a good thing or a bad thing, based upon your own feelings on the subject. Vanguard, a huge behemoth. We'll look at individual sites later, but again, these people, a lot of these companies have reputations for exerting a lot of control, a lot of power, controlling everything. BlackRock, the rest of them, but they are what they are, and they're out there, and they'll probably end up doing business with them. Bond mutual funds, less exciting to me. I guess that's kind of apparent. Treasury bonds, so obviously the yields are going to be a bit lower. Ginnie Mae, so it's going to be mortgage-based bonds. So again, they're not going to be getting the same rates, but in certain situations, there's a lot of bond investors out there. I'm just not one of them. But again, all of the professional people, whenever I talk to them about financial advice, they're always trying to steer me to bonds, but I've never done it, and I never had any regrets. And we've talked about bonds, how you can get high yields in bonds, but yeah, high yield is the same as junk. So, munis, if you happen to be in a specific tax bracket where most of the time people are drawn to munis because they're free, typically of federal tax, but you have to do a little bit of math to figure out how to compare the tax-free rate versus the fully taxed rate, and we'll address that as well. And then index bond funds, yep, same sort of thing. Rather than buying and selling bonds, there are bond traders out there, and a lot of day trader type people, just traders who get involved in bonds. But for you and I, in a mutual fund, it's not going to be that sort of program. International bond fund, same sort of thing. Non-U.S. global, so global meaning every place to include the U.S. And then you can do the same thing with the security or the classifications based upon their maturity dates. Okay, so the risk and returns, it's absolutely no different than the underlying securities. Don't forget that, if you own an equity stock fund, you own stocks. It's just you have somebody managing for you. So the way these distributions come, it's going to be a lot less paperwork for you at the end of the year, because you'll get a mutual fund, a letter from your mutual fund with the amount of money that you owe in the different categories, but it will be typically far simpler. And typically you tick the little block that says reinvest dividends and capital gains, meaning when they buy and sell stocks or they receive dividends, that they're reinvested, so you don't have all these piddly checks coming to you. It just makes things easier. So, anyway. So, short term, obviously longer than a year. Long term, longer than a year. What are we trying to show here? Risk and return, tax implications. So, yeah, same sort of things. Long-term capital gains, typically 15%. Short-term capital gains are taxed at your, top income bracket, which in this case they're using 28%. And so they're showing, what the difference is. Market risk. Yep. Conservative stock index fund. I don't know. Again, there are some. I would almost disagree with this, because you can invest in certain stocks that are just so unrisky, so boring. Just pay a dividend and do nothing. But if you buy across the whole index, you've included some of those boring companies, but you've also included some growth companies. So you've got, sort of maybe a balanced return. So it depends on the underlying entities. But in terms of the diversification, buying the whole index, that's a lot of different stocks, a lot of different companies that would have to go, fail before you'd, go to zero. So moderate, high risk. So not a lot of information being imparted here. Just pretty obvious. And the same with the bond. Same as the underlying bonds. You know, if the rates change, if rates go higher on new bonds, your older, lower rate bond is not as attractive. So they're saying based on diversification. Income funds, larger companies, a little, you know, not going to see exponential growth. Balance, so we got a little of each, so it's going to be in between. They're saying capital appreciation, which I'd put these two in the same category more or less. Stock potential return, I don't know. I don't see that much to be gained by going internationally sometimes. You know, Silicon Valley is where I made most of my trades, and that was more or less centered in the U.S., so going internationally might not have worked. Technology does have a lot of I mean, I agree with their risk characterization, but the potential return, a foreign growth stock, that just sounds like a lot of risk. With I think the higher return is down here in this level. So anyway, they're trying to make a pretty chart, but maybe not completely accurate. The problem with foreign stocks, you don't, number one, don't buy stocks on a foreign exchange without, you know, being basically suicidal. I mean, you're going to create so many legal issues and currency issues and everything else for yourself. No, you can find those companies traded on U.S. stock exchanges and keep everything simplified, or your whatever nation you happen to live in, try and buy through that market if possible. But the problem with foreign stocks is, number one, you know, the U.S., say what you will, but it is pretty stable economically, and also currency risk with, you know, with the euro, I mean with the petrodollar and the rest of that, and just the dominance. We don't have the currency fluctuations. I lived in Turkey for a few years, a couple, three, and man, they would just issue new bills. And the old bills, they would take them back, and the new bills would come out. They'd be the same amount, but what you used to need a 500,000 lira note for, now it took a 5 lira note for. It was just the inflation was just incredible. If you were holding cash in Turkey, you weren't holding very much cash within a matter of months, because it went away. So those currency risks, when you're trying to do investments, the people who live in the country, they know this. They don't hold cash. They want to trade in dollars. It's like Argentina, you know, with Milei, he's going to be using dollars down there because their own currency is just it's too difficult. So anyway, interest rate, bond risk. So yep. So if you're going to hold a bond for a long time, and it's a high yield bond, kind of a junk bond, so you've got something that's very sketchy, and your plan is to hope that nothing happens for a very long time. That's why that's in that category. Over here, low risk, it's because it's only held for a short time, so, you know, not that much time for bad things to happen, and it's in treasury bonds, government securities. The U.S. government is not going to fail, and if it does, you've got bigger problems in your financial portfolio. So, risk for investing in a bond mutual fund. So same. Yep. Must consider default. Must consider the interest rate risk. So everything, risk and return. High risk is not, well, with junk bonds, yeah, maybe that is just outright a bad thing. But taking risk is necessary. What you have to make sure is that your exposure to risk is balanced by an exposure to profit. If you've got all risk with no upside, don't do it. But you don't find, in a conservative thing, you don't find huge returns with no risk. It doesn't happen. They don't offer it because they don't need to. You know, it's like all these guys on YouTube that are telling you, oh, you can make a couple percent per day, and I've got this great. If you had that system that you purport to have, you would not be telling anybody about it. You would just be doing it and be incredibly wealthy. In fact, you would do the opposite. You would keep it to yourself. You don't want anybody else involved on your money-making thing. It's a fallacy to think that people who know how to make money are going to share it with you out of the kindness of their heart. They're not. So, anyway. Trade-off between expected return, mutual funds. So, I think we did this. Or we saw something very similar. Yep, we did this. The prospectus. Get back to that again. So that prospectus is the rules of the road. Tells a lot about it. Now again, you know, I'm not one of those learners that gets a whole lot out of just reading a document. I want to see what the comparison is. When I see expense ratios, how's that compare to somebody else? Or, you know, is there perhaps a company like a Morningstar, for example, who can say, yeah, this one gets a star less because it's got a very high expense ratio. That sort of guidance. I'm not looking for them to do everything. I would like sort of verification, validation of what I'm seeing is correct. Investment objective, yep. Investment strategy, past performance. Be very careful. I used to do this all the time. It used to be Money Magazine back when magazines were a thing. Anyway, they would always rate, and they probably still do in some form, their top performing mutual funds. And so you go, that's what I want. I want that top fund. And you go pick it, and that next year it just sort of flounders. And that's because there was probably some freak thing that led to just incredible. What you're looking for is long-term performance. Every one of these guys, right next to their graph telling you how much money they're going to make, they have a legal disclaimer that says, past performance is not indicative of future return. You know, they'll have some legalese in there to tell you that, yeah, we did really well last year, but our chance of, you know, getting a hole-in-one twice is probably not that good. You're looking for a consistent performance, and you're looking forward, not back. Any of these performance things are past performance. You're looking for future performance. Fees, expenses. So we talked about back-end load, redemption fee, they might call it. That means money you got to pay them when you get out. Not typical. I don't have any of those. I don't pay a load. I don't pay back-end loads. I do have to pay expenses. Obviously, I'm exposed to risk. I typically don't have anything that's paying me a dividend, and I'm all about capital gains. Capital gains is, you know, I buy it for $20 and I sell it for, you know, $1,000. That's a capital gain. Minimum investment, probably not relevant when you set up an automatic disciplined. You know, you're going to get 10% of your income each month. It's going to go into this mutual fund because you spent a weekend examining that mutual fund. You pick it, and you're good. And you set it up on your, you know, direct deposit or your automatic debit out of your checking account, and it's on autopilot, and you just sit back and watch it grow. It's amazing. The reason why we're going through this, especially on mutual funds, is what's going to happen typically, and I've been there a few times, when you go to a new employer, so let's say you get out of college, you get your dream job, you walk in there the first day, and they're going to go, they're going to hit you with a barrage of stuff. You know, what healthcare plan do you want? What, you know, where do you want your 401k to go? Choose one of these funds. Here you go. You got a week to decide. We'll meet again, and then you tell us what your picks are. And it's pretty overwhelming if you haven't thought about it before. And that's kind of where your whole term project plan comes. You go, well, I want to invest in growth stocks. I want to go with this percentage. If there's a match, I absolutely want it. You know, and you know all this stuff beforehand, because in a brand new HR meeting, you're trying to impress these people. You don't want to be the guy asking the stupid questions over and over again. Or you probably maybe moved to a new town to take this job, or you got a ton of stuff going on in your life right then, and you don't want to ask awkward. Now is the time where you can research this stuff, make all those things. You walk into that HR meeting, you already know what you want, and you're just looking for what they've got, and you know, it just makes life much easier. Anyway, this is what they're saying: narrow down your choices, use a table for comparison. Yeah, we don't need those numbers. Fidelity, again, we've kind of talked about the big boys. Again, all these companies are out there. They all have kind of the same product. Whoever you go to work with is typically going to be aligned with a certain company. You know, we deal with Fidelity. I think University of Alaska, they have Fidelity. Maybe they had T. Rowe Price, or there's also one that caters to education. I can't remember, but it's no different than the others. But they whatever. It's you know, I don't have that much preference for the different companies because it gets down to kind of convenience. They all will typically sell each other's products because they want to be your one-stop source. Quotations and mutual funds. So they're going to go through the sort of the tabular data again like they did on the other one, but the charting is just a much simpler option. So we'll look at that more than these numbers. But you know, mutual funds, even though they're mutual funds, they have ticker symbols just like a company would. So whatever their ticker symbol is, you look that up and you can look at the charts and you can look at all the info. Here's how one goes. You know, normally it would be well, here they're saying Blazer's a company, which I don't believe it is. But anyway, you know, 3-year return, whatever. Here they're getting about 9-10%. Doesn't look too bad. So, equity income fund getting 9. Yeah, I cry. Definitely a foul here. The growth fund is income funds. They're paying dividends. They don't typically do that much in terms of return. But anyway, could happen if they're combining the dividends in there, I guess. And then a closed-end fund. Again, we're not going to worry too much about closed-end, open-end. Quotations and mutual funds. So, there is a mutual fund education association that's out there that's not associated with any one particular company, but they're funded by all the companies, and they have broad information. Diversification among mutual funds. So, let's say you're saying, I remember hearing the term diversification. I need diversification. I don't want to be all in one stock, so I'm going to go in mutual funds, but I'm going to buy mutual funds from 5 different companies. I actually found this happen because I had TD Ameritrade, I had Fidelity, I had maybe Schwab or E-Trade. I've had all these different companies, you know, accounts with all these different companies at one point. And I had their technology accounts. And I looked at the underlying assets on all these different mutual funds, and they were pretty much exactly the same. All super heavy in Apple and Facebook and Alphabet, which is Google. And, you know, anyway, so if you think you have diversification, look at the underlying assets to make sure you truly have diversification. Because a lot of the top funds will be invested in the same companies. Impacted, and then this diversification. Sometimes people just diversify just for the sake of diversification. Can also diversify representing different countries. I want to be on the strongest horse, you know, just because nothing pejorative about Vietnam, but let's say Vietnam's not exactly killing it. Maybe they are now in the economy. I have no knowledge, but I'm just saying I don't necessarily want diversification to, you know, a country that's not doing well in the market. I want to be on the fastest, strongest horse predominantly, and so diversification for the sake, that's their argument always to me is, oh, you should diversify into bonds. I'm like, so my performance can go down? I mean, what am I gaining here? You know, show me some results that I would derive from that type of diversification. I want to be, smartly diversified, just not diversified for the sake of saying I'm diversified. Impact of financial crisis. Yeah, because a lot of times when one, the country does, when people get laid off and you're in one fund, everything kind of goes down. There are certain strategies. Back in COVID, people are like, well, people got to eat, they got to drink, so I'm going to those. They're not going to be traveling as much. Whatever. I never defense things. I've done that game where, there's going to be a war, so maybe we should be involved in that. I've never made any money in defense stocks. I've never made a dime in pharmaceuticals. Pharmaceuticals are just, every time I invest in pharmaceuticals, I lose. But anyway, and I've always done super well in tech. Maybe that's just based on the ones I've chosen, but but the markets tend to go, when the company starts laying off people, well, the employees who normally go to whatever restaurant, that restaurant tends to lose a little bit of business, and the whole economy tends to settle at the same time. So yeah, it is tough to find somebody who's going to excel in a bad economy. Again, this diversification. Yep, just about everybody does this now. So you can go on there and we can go to the Fidelity site and buy a Vanguard fund. It's probably not going to be featured. It's probably not going to be the one they're going to try and point you to, but if by God you want it and you want it under your Fidelity account, they're going to make that happen because they don't want you going to somebody else's website. They want you to be able to get everything in that one place. So, yeah, I hate to say it, a lot of these countries have not maybe got the same results. Or some of the better companies from some places will try to get listed on the U.S. exchanges. So, I am kind of, smartly, I think, kind of America first on that. There may be other reasons to go internationally, but, and like I said about the Canadian stuff, Canadian financial stuff, especially their stock market, because of the predominance of the mining stocks, it is the Wild West. Other types of funds, so hedge funds, yeah, this actually means what it says, hedge. So you've made a bunch of money in one type of fund, so you want to do, you want to protect your wealth, so you maybe come up with a hedging strategy, something that's not correlated. Let's say, like I mentioned, NVIDIA's way up right now. So if I was doing a hedge fund, I'd want to find something that perhaps would go up if NVIDIA goes down to hedge against that. For NVIDIA right now, I am a bit concerned. It's above like $900, and I'm in it like $36. So I put trailing stops in for 10%. So if the price drops more than 10%, I'm out. If the price keeps going up, my trailing stops keeps following along. That's kind of hedging that I would get involved in. I looked at the options, and options would be a method to, have sell some shares short or have an option for shares being sold short. So in case the price drops, I make money that way. But it's a bit more expensive. It's just a bit easier for me to use a trailing stop. But anyway, different ways of doing it. But hedge funds are typically, you got to sign some paperwork if you're actually going to be involved in a hedge fund. You have to be, sort of a high wealth, experienced investor, because people get cleaned out, and then they complain to the government and say, I didn't know. And so they've made certain rules where, at least on paper, you have to sign, something saying, oh, I've done this before. I know what I'm doing. I've got so much in assets. I'm not going to become a ward of the state, if I lose this money. Yeah. Anyway, Madoff, famous dude. One of these things, though, people were getting 20% per year with no risk at all. And he ripped them all off. It was a big Ponzi scheme. And he was very high up in that whole industry. I want to say he was running... he was involved with one of the exchanges very high up. Memory escapes me. Okay, so on to some homework. So what we're going to do here is, first off, when I talk to you about there's a tax-free, muni, a bond, that you should get this because you don't have to pay any income tax on this bond, so it's a no-brainer. Well, not exactly. Let's say that bond is paying a great rate. Let's say it's paying 7%. And in the stock market, you think you can get 10%, or you're getting 10% or better. Which investment should you take? Well, in this one, we've got these other numbers, but I'm going to use my 7 and my 10. So, if you make 10% in the stock market, let's say you invest $1,000. Let's say if you invest 10% in the stock market, or you earn 10%, you're going to earn $100, right? But because of the 28% bracket, you get to keep how much? $72 out of that. Let's say you had, a bond paying 7%. A bond paying 7% on $1,000 would earn you $70, right? So which one do I take? Well, by $2, I would take the 10% one. So anyway, there's more math involved, but the big thing is you got to know your tax bracket. If you're a college student or somebody not paying much in taxes, it doesn't make a whole lot of sense to do mutual bond or mutual munis because your tax rate's not that high. If you're somebody who lives in California, your combined tax rate between the state and the Fed is like 63%. So yeah, it makes these numbers change dramatically. So you have to know what your rate is before you can make that decision whether the tax-free bond is a good idea, bad idea. Simple problem here, not a big deal. Interest rates, we've talked about that. Just think about your bond paying a low yield, and you want to sell it. Does somebody want to buy it? So the interest rates are correlated to the worth of your bond. And then another one. 20 years ago, current dollar value, how much did you make? So another word problem. Not too difficult there. This one, though, is a bit more involved. It doesn't need to be, a huge 3-page thing. It does need to be a paragraph, so we're talking like a, half page or something like that. There's a podcast. It's focused on the bet, what they call it, and 15 points, and the rest of it. So what they're talking about here is there's two guys, Warren Buffett being one of them. Buffett takes the side that all these guys buying and selling and trading are just creating a bunch of churn, and they're making investors poorer. What you need to do is you need to buy just an index fund, buy and hold those stocks, and you'll make more money. And the other guy on the other side, I think he's associated with Vanguard, he says no, that an experienced, capable trader can get a high return than somebody who just buys and holds. And so it's back a few years, almost 8 years now, but they put $1 million bet on it because they're those kind of people, and it all goes to charity. And so but it goes through the whole thing, brilliant versus boring. Brilliant would be making money with very little effort. Well, that's brilliant is the whatever. You can size this up however you want. The way they do it is brilliant is the brilliant stock picker, and boring is the just buy and hold. But I would argue they're actually different. If I can make money without doing any work, that's pretty brilliant in my mind. But each to his own. The paper itself, again, however you want to do it, look at it maybe like a checklist. Go through and do like little outlines for each one of these things and identify them. What kind of life insurance am I going to get? Well, I'm not going to grade you if you don't say term, and you're not going to fail. But again, have good reasons if you choose whatever type you do. Investment portfolio, what your risk tolerance is. Everything is individualized to a situation very similar to what you expect yourself to be in. You probably don't know what situation you're going to be in, but you got an idea. You got a forecast. I by no means want your personal data. You just come up with whoever, Bob or Becky or whatever name you assign to this person, and you kind of lay out their life. The more similar it is to yours, the more useful it's going to be to you. But that's it. My voice is going, so we will wrap it up. Talk to you next week.